In this video, I want to introduce a very accurate indicator on TradingView that will blow your mind. To add this amazing indicator to our chart, here we click on indicators and we search RAVIFX Fisher, this one, which is written by LOXX. Alright, this is the indicator, and as you can see, it's added here below the chart. It is in the form of an oscillator, and as you can see, we have a histogram that is moving above and below the center line, which is 0. This indicator is a special implementation of RAVI indicator, Range Action Verification Index, which is calculated based on moving averages of different lengths to identify trends. In this indicator, weighted moving averages are used and also ATR, average true range, and then it is normalized by Fisher transform, which converts the prices to Gaussian normal distribution and signals when prices are moving significantly. So basically, the Fisher transform can help identify reversals or big changes in the price movement. As you can see, in this indicator, we have two horizontal lines, which one of them is set at 0.07 and the other one as minus 0.07. In times that the histogram is between the lines, like here in this part, this shows that the market is flat and we shouldn't enter any trade. But in times that the histogram goes above the line, I mean above the upper line, it shows that the market started advancing, and when the histogram goes below the lower line, it shows that the market is declining. So basically, this indicator helps you to know when the market is trending, so you can have the opportunity to enter a trade, or when the market is not trending, so you stop trading and avoid false signals during flat market. By trading only based on this indicator when the histogram goes above the line or below the line is not enough to have very accurate signals to enter a trade, and you need another indicator for more confirmation, because sometimes we can have the histogram above or below the line but just temporary because of a sudden and very short-term increasing of momentum and volatility in that direction. So we need more confirmation for any trading decision. One excellent indicator is Andean oscillator, this one, which is an editor specs indicator and written by Alex Grover. This indicator is also a powerful indicator with the same functionality like this one, which means it also helps you with trending and non-trending market, and together they give a very accurate signal. If you worked with Andean oscillator, so you know that when the green line is above the orange line, the market is in an uptrend, and when the red line is above the orange line, the market is in a downtrend, and when the orange line is above the other two, the market is not trending and moving flat. Alright, now let's see how we can find trading signals based on this setup. This strategy is suitable for low time frames like 1 hour and lower. Right now we are on 15 minutes time frame, but for lower time frames like 5 minutes or 1 minute, we need to adjust the lines, I mean these two horizontal lines here in this indicator, and we need to make this band tighter so it can correctly show the flat market and the points that we have increased momentum and volatility. So depending on the time frame and also volatility of the asset you're trading, you need to adjust the lines, which by a little exploring of past data you can reach to an optimal settings. Alright, now let's see how we trade based on this strategy. After a period of flat market, which is shown by the help of this indicator when the histogram is between the lines, when we get the first bar closed above the line, this is a buy signal, and the buy signal is confirmed only if in Andean oscillator the green line is above the orange line. So here the buy signal is confirmed and we can enter a long position at this point when this new candle is opened. The stop loss below the previous swing low and the profit target at 1.5 risk to reward ratio. And on the other hand, for a short position signal after having a flat market, when we get a bar closed below the line, this is a sell signal, and the sell signal is confirmed only if in Andean oscillator the red line is above the orange line, which is not the case here. So this sell signal here is rejected, but for example this sell signal here is confirmed because in Andean oscillator the red line is above the orange line. So we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high and the profit at 1.5 risk to reward ratio. Moving on the chart, again here market became flat, and at this point we got a bar closed below the line, and in Andean oscillator the red line is above the orange line, so the sell signal is confirmed and we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high and the profit at 1.5 risk to reward ratio. Moving on the chart, again market became flat, and at this point we got a bar closed above the line, and in Andean oscillator the green line is above the orange line, so the buy signal is confirmed and we can enter a long position at this point when this new candle candle is opened. The stop loss below the previous swing low and the profit at 1.5 risk to reward ratio. Moving on the chart, again here market became flat, and at this point we got a bar closed below the line, but in Andean oscillator the red line is not above the orange line, so this signal is rejected. Moving on the chart, here we have a bar closed above the line, and in Andean oscillator the green line is above the orange line, so the buy signal is confirmed and we can enter a long position at this point when this new candle is opened. The stop loss similarly below the previous swing low and the profit at 1.5 risk to reward ratio. One point I must mention here is that when you have a confirmed signal like this one, where in Andean oscillator the green line is above the orange line, you should wait for Andean oscillator to have the orange line above the other two, like here, and then you should start discovering another trading opportunity. For example, here we don't enter a trade based on this signal because in Andean oscillator we didn't have the green line below the orange line before the signal, but after this you can see that the orange line went above the other two, and now we are ready for taking signals like this one here, where we get a bar closed above the line but not confirmed by Andean oscillator because the green line is not above the orange line, so the signal is rejected. So we wait for the orange line to go above the other two, and when this happened in this indicator after a period of flat market, when we get the first bar closed above the line, this is a buy signal, and the buy signal is confirmed if in Andean oscillator the green line is above the orange line, so this is a confirmed signal here and we could enter a long position at this point. But one important point that I must mention here is that when you have a signal right after a gap like this, it's better to ignore the signal. In this case the trade would be profitable, but many of the times we have the price going back and filling the gap, so I recommend you not to enter a trade in a situation like this when you have a trading signal right after a gap. As I explained earlier, we don't take these buy signals because from here where we had a confirmed signal we didn't have the orange line above the other two until this point, so from here we are ready to take signals. This buy signal here is rejected because in Andean oscillator the green line is not above the orange line and we don't enter any long position at this point. Moving on the chart, this sell signal here is also rejected because in Andean oscillator the red line is not above the orange line, but for this sell signal here the signal is confirmed because in Andean oscillator the red line is above the orange line, so in practice we would enter a short position at this point when this new candle was opened with the stop loss above the previous swing high and the profit target at 1.5 risk to reward ratio. But you can see that we didn't have enough declining of the price before the price turning up and hitting our stop loss, so this trade would end up in loss, and this is an important point that you must pay attention. Although this strategy is very accurate and can help you to find very good trading opportunities as I showed you earlier, but we can also have losing positions like this. No indicator or trading strategy can give you 100% guaranteed signals, and losing positions are always part of the game and you need to manage your risk properly, otherwise you will definitely lose your trading account sooner or later. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategy that you can use. By the help of this strategy, your position size is calculated in a way that you will lose only 1% of your trading account if the price goes against you and hitting your stop loss. I have a complete guide on this, the link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new video. See you guys in next video and good luck with your trading.